Quang thì gọi ông rồi cho ông bao nhiêu cái đồ mà đeo ấy.
Hello?
Hello?
Hey, what's up, guys?
Oh, hey, what's up, Chen?
Hey, what's up, everybody? What's up, Daniel?
Hanging in there, man. Keep busy.
Yeah, I literally just made it to Toronto, guys. I'm really sorry for the short notice. I had a issue within the family, and I had to go on very short notice. I actually thought I was gonna make it to Toronto by around 5, but the traffic coming into Toronto was so horrendous that I didn't get to my destination till now. Literally just stepped in. So I thought that I was going to be able to hold the class and continue the bond session, but that doesn't seem like to be the case. So, guys, please bear with me. You're in very good hands. Daniel is an expert in technical analysis, and we used to work together a couple years back running the trading program at the IOTAP. Today, Daniel has some very good stuff on technical analysis for you guys. So I hope you guys enjoy your time with him. And I know you guys are going to learn a lot from him. So Daniel, thank you very much for helping me out on short notice.
Not a problem, buddy.
Yeah. So I just wanted to jump in and let you guys know my situation. I literally still have my jacket on. So. Yeah, but anyways, I'm gonna let you guys go. I'm gonna let Daniel run the class, and I hope you guys have a good class for tonight. I will be back. I'm actually heading back to Toronto, to Montreal tomorrow, it'll be class as normal for Thursday. Okay, guys.
Okay. Sounds good, buddy. Looking forward to having you back.
All right. Thank you. Have a good one, guys, and enjoy your class.
Take care, buddy. Be safe.
Thank you. Bye.
All right. Cool. So I guess we could go ahead and get started. It's around 7:05. I guess it's just you and me. What was your name again?
Hi. Actually, I'm on here too.
Oh, okay. So I have two people.
You click on participants, you can see there's 3 of us.
Okay, cool.
Ross is going to be late. Ross is actually coming. He's just going to be late.
Okay, no problem. I'm a little new to Zoom. I usually
that's all right. I've never hosted before, so I'm sure I'd be the same way.
Yeah, cool. I usually use GoToMeeting, and there's TeamViewer. There's so many of them now, so I just kind of fumbled my way through it and pretty much hoping for the best. So gonna have to
no problem.
Gonna have to forgive the inevitable technical glitches.
No worries.
So I'll just pull this up. We're gonna talk about the market events here in a little bit, but can you see this? I just maximized the Forex Live.
Yeah.
Okay, cool. So just a little bit about myself. I know I kind of popped in there. You've seen me become somewhat active if you've been paying attention to the general channel. I'm going to start kind of becoming more active with the program and helping take some of the burden off Chen. Just a little bit about me. I've been trading for my mother actually taught me how to trade stocks when I was 6 years old, because we're Eastern European and the women in the family, run the money. So I've had a lot of experience with trading and in particular stocks, but also futures and all that. And, again, just a little history. I majored in math and physics, and I wanted to go into quantitative development, with high frequency trading algorithms and all that. And that was in 2008. Well, we remember what happened in 2008, right? So that didn't exactly work out as planned. So I just kind of, struck out on my own, got a boring software engineering job, and, gradually got into trading just on my own. And now I've just now started a capital management firm. So things are finally, going pretty good. And Chen and I have been trading together since 2015 or so from the old school. And, we have a very good rapport because he's, we both understand technicals and fundamentals, but he's a little bit more on the fundamental side and I'm a little bit more on the technical side. And I understand that he's gone over technicals with you already, but, maybe I could provide some insights and also in light of today's trading events and current events and all that. So on the docket today, I think you saw my schedule, my itinerary, or if you will. Just kind of going to go over some current events in the news. This is what we're looking at right here. And then we'll go over some charts together. We could look at some technicals, discuss some trading ideas based on these events. And then after that, I can go into some of the modules and maybe, if it's a review for you, that's great. If I'm boring you, let me know, and I can fast forward a little bit. But I'm going to otherwise talk about, some trading setups. These chart patterns, when you see them, how do you trade them? What do you do? Where do you enter? Where do you put your stop loss? And that kind of thing. And then we'll move, if we have time, which I doubt. But if we have time, then I'll move into market profile. I think Chen's already gone over that, but I have a unique way of doing it. So, any way I can help make you guys more well-rounded, balanced traders, I'm all for it. So, questions so far? I know it's pretty much just the intro.
Nope.
All right, cool. All right, well then on into what was kind of driving the trading today. There's 3 events. There's actually kind of a bunch of stuff going on, but I identified we don't want to be here all night, so I identified kind of the top 3 things, and that was earnings today. The stock earnings really, there were some really big companies that blew it out of the water. There is also trade deal updates. It's been an ongoing saga, and it sounds like there's finally some traction, but every time, we think about that, there's, we always get a little surprised. So I think you guys have seen enough of this thus far to understand that this can be a very volatile process, and the pendulum pretty much swings back and forth between this irrational exuberance and hope and to dismal despair, doom and gloom. So right now we're in the hope phase. And so get ready, if we don't hear anything concrete soon, for us to swing back to the other end. But that's just how it goes. And then finally, we have some Canadian data. Okay, so me and Chen talk about this all the time, so I don't know how much he's covered in class, but I imagine it's been significant about the BOC, how they, the Bank of Canada, how they handle their interest rate decisions, and their press conferences, and what that means for the economy, what that means for trading, and the surprises we could see when they do eventually, make a decision. But I'll cover that in more detail in a minute. So the specifics, I kind of have them identified here in these little arrows, right? So the red I chose to be Brexit stuff. So basically, there's just some progress, quote unquote, whatever that means. The EU and UK are closing in on a draft Brexit deal, but this is the main thing: is it hinges on the DUP support. That's the Irish border that's been giving them a lot of problems. But later, we see here that the EU. I guess that's the same thing. They put it twice. Okay, this is the one I wanted. DUP's foster. We must remain within the UK customs union, entirely within the UK. But in the details here, he was basically saying that he's confident that they're going to come up with a solution that he likes. So, in other words, there's hope, right? Which is pretty much, it was very, very, very well anticipated, because there's been a lot of problems. And in fact, I still read how the Liberal Dems are still pushing for another referendum. So hopefully this can get signed off soon, so that we can get out of this little volatile phase for not only the euro, but the British pound as well. And then the final data point was on Canadian existing home sales. Canadian data has been very bad lately, but we've had some very strong data coming out of Canada. I don't know if that's a fluke or if that's really a statement as to the Canadian economy, but I think that even if, again, this is a conversation that Chen and I have had on the many times about the Canadian economy, that eventually, even if we are doing well here, I'm based out of Montreal now, by the way. Even if we are doing well here in Canada, eventually the nonsense of the world, especially the US, is going to catch up. But the point is, for now, we've had some pretty good data points coming in. The employment data was a big beat. I believe that was on Friday. And so for the moment, we've had some good data. So any questions on those current events? Anything you guys want to add?
No.
Okay, cool. All right, so we can kind of transition into the actual trading ideas. I guess I'll start with the Canadian data. So the Bank of Canada has a big tendency to not really give much forward guidance and basically say, okay, all is well, beat the drums, and just status quo, move along. And then all of a sudden they give you a surprise rate cut or rate hike out of nowhere, right? So what effect do you think that would have on the economy, or sorry, on the let's say stocks, for example? Anybody want to take a guess? I'll make it more clear. I'll make the question more clear. So, for example, in the U.S., right, the Fed is really big on forward guidance, which means that they keep hinting to you that they're what they're thinking. If the data keeps being bad, we're going to cut rates. If the data keeps bad, they keep kind of hammering that. They do that with QE too, right? So, what do you think? What effect do you think that would have on, say, the S&P versus the TSX? Anybody want to take a guess?
Sorry, can you repeat that?
Sure. So I'm talking about the central bank policy, right? In terms of when they meet, the minutes and the press conferences that they give. The Fed is really big on forward guidance. And what that means is that they give you a hint in advance as to what their decision is going to be, whether it's going to be a cut, whether it's going to be a hike, or whether it's going to be a hold. And they do that for a reason. They did, and this is kind of what I'm getting at with the question. Whereas the Bank of Canada, they don't really do that. So, what effect do you think that would have on let's concentrate on stocks? What effect do you think that would have on the TSX versus Canadian stocks versus US stocks?
If the rates were cut?
I'm talking about the forward guidance. And okay, yeah, let's make it more general. Yeah, let's talk about the forward guidance and the rate cut. So let's fundamentals, right? What does a rate cut do for stocks?
I would think that interest rate cuts the stocks would increase, right?
Yeah, absolutely.
Trading, yeah.
So why is that? Well, because basically money is easy.
Because money is easier.
Yep.
It's cheaper to borrow, right?
Right, exactly. So money becomes at zero, right? Where it was zero, basically money was free, right, or a very, very low interest rate, right? So when you have a low interest rate environment, companies can take out loans, they could do their research and development, they could fund stuff. When you tighten interest rates, you tighten fiscal policy, which means you raise interest rates, that means it gets harder for them to do that. Okay.
Right.
Now there are some exceptions why hiking might be a good thing. For example, like when we had interest rates at zero for like 8 years, and they had one hike of like 0.25 basis points, or 25 basis points, that is. That was interpreted from the economy as being a good thing just because the economy was so shitty for so long, right? But that's rare, right? So there's always some asterisks. You gotta do your homework. But what I'm getting at with the forward guidance is expectations. Okay, so if you remember, all trading is based on what we call E, or expectations. So if we expect good data and we get good data, even though the data is good, we don't really move the markets too much, right? What moves the markets is if there's a surprise, okay? So as the Fed is giving you forward guidance, that basically sets the expectation for a rate hike or a rate cut. Does that make sense? Because that's its job. That's what forward guidance is. They're giving you a hint as to what is going to happen.
Okay.
The Canadian central bank does not do that, or at least they give you this dog and pony show about everything's fine, don't worry, keep looking the other way. Okay, so in other words, we have no idea what the expectation is. Now, there was a study, just to really drive this home, there was a study that says, contrary to what we think, when the Fed, again, this is the context, we're going back to the US, when the Fed increases or decreases rates, stocks actually retrace. So in other words, if the Fed lowers interest rates, stocks, in like a week from when they did that, are going to retrace a little bit. Why? Well, because the expectation for them to do so was set in the forward guidance. With the Bank of Canada, if they cut rates, stocks are going to fucking skyrocket because there's no forward guidance, or very little anyway. So the expectation is set very differently. And we're now that I've kind of gotten through that, we can take a look at some examples. Okay. So was there any questions on that little explanation I gave? I know that it came kind of quick.
Nope.
No.
Does this make sense with what you've understood based on the discussions of interest rates and all that?
I think so, yeah.
Okay, cool. So what we're looking at here is an ETF on what is this? The TSX. Okay. Now, the stocks. First of all, stock indices or indexes are just numbers, right? They're not real things. They're just aggregates of measurements of company valuations on the stock market, right? What you can trade are futures contracts on those indices, options on those indices, CFDs on those indices, and what we call ETFs. Okay, are you familiar with what the difference between all those things are?
Maybe a little bit.
Cool. And again, I'm not really familiar with where he's at in the course, so by all means, if I'm saying something you don't understand, please stop me and I'll flesh it out a little better.
Okay.
But anyway, when you have a futures contract, that's very different from an options, which is very different from an ETF. And right now, we're looking at what's called an ETF, and that's called an exchange traded fund. And basically, what that means is you're dealing with an object that acts very much like a stock. Okay, it's traded on an exchange. It's a fund, right? And it's an aggregate of the companies that are in this case, the TSX. The other one that we like to look at is called the SPY. That's the big one for U.S. stocks. And as you see, based on all these levels here, this is something I look at quite a bit. But again, it acts like a stock and it trades like a stock. Okay, so if you're a stock trading guy, this is and you want to trade just stocks in general, this is something you want to look at. If you want to trade specific stocks, obviously you look at that. But this again is an aggregate of the stocks
So
that are on the
you see the SPY is like a collection of stocks put together, like almost like a portfolio.
Exactly.
You can invest in just that if you want.
Absolutely. Yeah, absolutely. And ETFs are a pretty cool animal because, with futures, me and Chen like to trade futures, but it's not for everybody. And the reason why is because you have this thing called margin, right? So if I was to enter a position, let's say oil at, let's see what oil is trading at. So if I was to enter, let's zoom in here because obviously this is something I look at all the time. So my charts are nasty at day levels. All right, so we have the tick values are the cents. You see as I'm moving my cursor, you see like 50, 52, 89, 88, 87, blah, blah, blah. Those are tick values, right? So that's the minimum size, the minimum difference in price between the contract that you can have. So what that means, every tick is $10, right? So let's say I just said fuck it and went long on oil at 52.92 with one lot. If oil drops down like to from 52.92 to 52.88, I just lost $40. But people typically don't trade just one lot of oil; they trade like 5, right? So in those 4 ticks, I just lost $200, right? So if you have a long-term expectation of something, or if you want to hold the position for a while, futures might not be where you want to go, especially as a new trader. However, if you look at something like this, DIG is, this is kind of ugly looking. So let's look at it on a day. Okay, this is it's an ETF that tracks oil. Okay, so the same kind of principle that we apply to stocks in terms of an ETF, like you mentioned, it was a basket of stocks or a little portfolio. We could do the same thing with oil. We can also do the same thing with bonds. We could do the same thing with hog futures, for example. That was a big trade that was a couple 4 or 5 months ago. So an ETF is a little fund that tracks something, whether it's stocks or oil or bonds or whatever. So when we're looking at the TSX, right, we see that again, this is an ETF product that tracks the behavior of something, right? In this case, it's Canadian stocks. The one that we looked at before was the U.S. S&P 500. The U.S. has several major ones, right? We have NASDAQ, we have Dow, we have...
Why is it called TSX 60?
Because I believe there are 60 stocks in the index. Yeah. So you see the number after it usually means that. I don't know offhand if that's correct. I could fact check myself. But you have Dow 30 and all that. That means there's 30 stocks and so forth. So you get the idea.
Right.
So what we're looking at here, and this is a trade idea, right? Again, educational purposes only, all those disclaimers, blah, blah, blah. Let's get rid of some of these lines here. All right. So this makes the levels a little bit more easy to identify. Going back to our fundamentals discussion, if I expect, Ross says he can't log in. I don't know. Any ideas why he can't log in?
I think he needs the password, right?
It needs the, let's see. Did the link work for all you guys?
Yes, it needs a password to log in.
Okay, the password, what was that? Oh, this one?
Yeah.
The other option there may be, because I have like the free Wanker version of this. I literally just downloaded this. So maybe there's a limit on how many people I can have. It's usually like 5, so I don't think you should have a problem. All right, I'm just gonna go back to this. We'll see if he replies. Okay, now going back to our discussion of the Bank of Canada rates, what do you think would happen to this if they cut rates, right? So what happens to stocks? It goes up, obviously, right? Now, does that mean that I just want to just randomly buy this? No, because the stock market or the asset in general can do a lot of things before we have that decision. So again, we could just go through some basic technical analysis on this. You saw how I drew my Fibonacci's because again, I'm thinking long-term with the TSX, right? I'm not thinking to day trade it. I'm not thinking to, even maybe you could consider it a swing trade, but I want to figure out, okay, well, the good news is I'm recording this, so we can post it later. Any ideas? I don't know.
No idea. Either you can click on the link and then it's work, or you can do manual, put the meeting ID and then password.
Okay.
That way it work, but I'm not sure why it doesn't work for you.
Thanks for that. I have no idea how this works. So Appreciate your input. Okay, so if I'm looking to, if I expect the Bank of Canada to cut rates, right? Again, this is just a hypothetical, you know, draw your own conclusions, but we think that it's reasonable, right? Because the U.S. did it. The Bank of Canada almost always follows in lockstep with what the Fed does. With the notable exception that we've had some pretty good data points come out of Canada, but I'm not entirely sure if they're good enough to overshadow what you know, their tendency to follow in lockstep with the Fed. So going back to our technicals, I have the levels drawn out here, but you know, again, we don't just want to jump into a trade on this. We want to try to get the best price possible. And I'm going to talk a lot more about that when we get to the trade setups module, because there's 4 key factors, I guess, to risk management when you're trading, right? Anybody want to take a guess what those are?
What the question again?
So the question is, in your risk management. Okay, 1 second. Let me just go for. Okay. So going back to this, there are 4 key factors in risk management when you're trading. Anybody want to try to take a stab at one of them?
I don't know.
Okay, that's okay, because this is part of why you're here, right? To learn why. And the thing about risk management is, obviously you have a lot of things about emotions and things like that, but when it comes to trading, there's only 4 key points that you need to do and do well, right? Profit target and stop loss. Okay, whether you're sitting there watching your trade, or whether you just, what we call, set it and forget it, which is set your entry, set your stop loss, set your profit target, and let it go. You still have to take that into account, right? The third one, that's, in my opinion, the most important, is your entry price, right? So if, let's say I was to enter a trade right now, I'm really greedy. I enter this trade right now at, say, 24.78, right here at around the close. And so let's say my profit target is here, up at this high. Makes sense. It might retrace the channel, but it also might retrace this area here to my Fibonacci level. We know Fibonacci levels in general act as kind of magnets, right? So let's say if I set my profit target here, if I'm really greedy and I want to jump into a trade, it has a high probability of retracing and stopping me out. And I'm going to tell you guys, this is the most common mistake in trading when you're new. And you should really take note of this, because I see it happen to everybody, all right, including myself. When you're new and you want to enter a trade, whatever you think is your stop loss should be your entry, right? So in this particular case, again, this is a hypothetical example, but let's say I wanted to enter this trade, you know, jump into this trade right here. Very high chance of this retracing here and bouncing, right? Of course, we equally have a chance of it, you know, we also have a chance that it's going to go and retrace up here, but, you know, fairly high probability we're going to test this again, okay? So if I was to set my stop loss here, I'm kind of asking for it, right? So instead, what we do is we live to trade another day, right? So instead of just entering aggressively at market, we might want to consider entering at one of these levels, okay? So why do I have this red line drawn here? What's special about this? Anybody?
It's kind of the bottom of where it's been.
Yeah, exactly. So
targeted.
Exactly. So there's lots of ways to identify levels. And one part of that is using the Fibonacci's. I love Fibonacci's. They're almost always very good indicators as to where the stock might go, or the asset in general might go, especially when you don't know anything, right? When something's just mooning like Bitcoin did, we were able to use Fibonacci extensions very, very well in order to project where it might go. Okay, but in between, then you see it's also a fairly good indicator. This is not the best example, but it's also a fairly good indicator of the levels in between. Okay, so we have this being a very strong Fibonacci level here, very high probability that it's going to test and bounce off. But we also have this low here, right? Does anybody remember the, like if I was to draw, let's see, where the tool is. Looking for the channel tool. Oh yeah, the pitchfork. Here we go. Okay. All right. Sorry, I'm working on my Mac here, so the screen isn't, come on, it's not seeming to cooperate with me. Anyway, I'll just draw another trend line here. Okay, so we have two of these horizontal trend lines. And basically this action in here is what we consider to be a channel, okay? And what that means is that the price is pretty much consolidating, or the range is narrowed down to within this interval here, with the exception of this little outburst here. We call that a failed channel breakout. Now I know I'm throwing a lot of stuff at you guys here. Have you covered channels yet?
I don't know what
I don't know.
Okay, so a channel is basically how you identify, and I talk about this in my trade setups module. So what we're going to do is I'm just going to throw this material at you, and then we're going to review it and get down to more like the science of it in the module. So forgive me if I'm moving too fast, but basically when you have a channel, that's where the behavior likes to hang out, right? So in this channel, that's defined by these two levels, we see that we have these highs here and these lows. So in other words, the price likes to bounce back and forth, okay? So based on that knowledge, where would a really good entry point be if I want to go long?
Probably at I'm going to guess here 0.786.
Yeah, that's one of them, sure. And the reason is because that's a very strong Fibonacci level. Okay.
If you don't buy market, it still might fill, right? The order.
Oh, of course, yeah. If you buy market, I never buy market, and I'll tell you why. First, you tend to get a shitty price.
Yeah.
Because they I have a module just dedicated on order types and what you use and why. And I gotta turn these goddamn notifications off. Sorry, guys. Nope, that's not what I wanted. Anybody know how I can turn notifications off in a Mac? Just do this. Sorry about this, guys.
That's all right, no problem.
Oh shit.
See, it says nothing right there.
Yeah. No, but I'm yeah. Thank you.
Yeah.
Okay, perfect. Okay. All right. Now it's telling me, oh fuck, as a basic user, your free meeting has a limit of 40 minutes. Zoom is giving you 1 time free to extend to enjoy unlimited meeting for free. Okay, that's good. All right, so we're good. All right. Okay, sorry about that interruption. Okay, so we're looking at the levels and where we might identify good buying opportunities. Buying at market is something you typically don't want to do, and the reason is because you tend to get a shitty price because the market tries to fill you in as soon as possible, and that's very rarely at the price that you see on the chart that you obviously want, right? Because you're being aggressive, it'll fill you where it fills you. There's all sorts of shenanigans going on in the back. Yep.
When would you actually buy at market? Because I made that mistake with Canopy Growth.
Sure. If you want to buy at market, it's because you really have a strong conviction that the thing is going to break out imminently. And even then, what you want to do is maybe set up your trade, right? So let's extend that example. Let's extend that discussion for this example right here. Granted, this is on the day chart, so it's a little it's a little dishonest, but you get the idea, right?
So I mean, if it's continually going up and you really want to get in, you might buy market, right? But
yes.
You may not get in at your price that you're ordering in.
Yeah, you can't.
So that's kind of, I guess, one instance where you probably would.
Yeah, but you almost you never want to, if something's just rocketing like this, you never want to buy at market. And the reason is because I don't know how this happens, but it's like the markets hear me, right? And then they retrace as soon as I enter in at market. Where you want to enter in at market is before this, where you feel it's imminently going to go, okay? But even then, you want to set up your trade. Okay, so you want to have a clear, defined plan, because often with market, even before that, you will get a little bit of retracement. That's just the nature of the game, and you want to take advantage of that. And there's all sorts of reasons that retracement might happen. We have squeezes, we have profit taking, we have just the volatility in the markets. That's something you're going to have to get to know as a trader that's unique to your product, right? And you want to set up for that. You want to plan for that. So if you enter in a market, again, it's because you think it's imminently going to break out, never because it's already broken out. If it's already broken out, you've just screwed yourself, because even if you're on side a little bit, guaranteed it's going to it's going to retrace. And you want to capitalize on that retracement. So let's say I feel for whatever reason it's just going to break out here. What I could do is enter a piece of my position here and add to it here and maybe add to it here. Okay, so in the average, even though it's gone down quite a bit, if I still feel that I still have absolute conviction that it's going to go up, right? It's technically called averaging down, and it's a mistake if you do it in the moment. If you plan for it, that's called entering at levels, okay? There's a difference. You never want to average down because you're losing in a trade. You want to plan for it. Because if the market doesn't go up, that just means you just didn't get that just means you got a shitty price. Okay, so you can plan on that and enter at these levels and get a good price when it retraces. And me and Chen do that all the time. Do you guys understand that explanation, what the difference between averaging down and buying at levels is?
I think so, yeah.
So for example, if let's say I bought here, right? And this just craters, right? And I didn't plan on this, so I'm like, oh crap. And then I buy, maybe here, I buy maybe here, I just buy all the way down because I'm panicking, right? That's called averaging down. Now, if I was smarter, I would have bought here, then maybe set a limit here and maybe a limit here in advance. And the reason why doing that in advance is so important is because of risk management. Right, because if I'm averaging down in panic, I have no idea where I can get out, right? But if I do so in advance, then I know where my average price is and I can set my profit target and stop loss. So
you're saying you're actually going to place 3 orders to buy, and then it gets lower. You place an order lower and another one lower.
Yeah, and you can set
those because it won't hit the order, it won't fill it if it doesn't go there. But then that way, you're saying you're averaging losses.
Exactly. Right? Yeah, exactly. So let's say it does break out. Well, hey, at least I got some. I got a third of my order. Let's say a third of my order in, and it does break out. I've made a good trade, right? if it retraces and then it goes, right? So let's just draw this. So the first option is this, right, where it just moons. I got a third, hypothetically again, I got a third of my order in here, right? Let's text.
So it's almost like, I'm thinking like poker, and when you lose two hands, your next hand's most likely not going to be, so you kind of increase your bet,
exactly.
Eventually your odds of losing all the hands are very, very slim. You got to win one, right? So then that way you get back up to that level.
Yeah, and it's even better than poker because
like how I'm looking at it, I guess. I don't know.
No, you're absolutely right. And it's even better than poker because you have fundamentals on your side, hopefully. The ideal setup for a trade is you have the fundamentals and the technicals on your side. And at that point, it's just a matter of letting the markets do its thing. So here we have an example where, okay, if I entered a third of my position here and it rockets, well, hey, I made money, right? I didn't make as much money as I wanted to, but I didn't risk.
You don't have to worry about the other orders filling, right?
And then who cares, right?
Because they won't fill, right?
They won't fill. So fuck it. Let them expire or cancel them, right? Now, let's say this option happens, right? Let me color that different color, light blue. Okay. So if we have the blue option, well, hey, we got filled on everything, right? And then blow that up a little bit. And then we hit our profit target, right? So instead of just having a third of the trade here, we have an average price somewhere probably a little bit lower than 24.53 with a lot more size, and it retraced further, right? So the difference between here and here is less than the difference between here and here. So here we made less money, but we also took less risk, right? Because we didn't bet it all on red, from the beginning. Right, but here we got filled everything because we planned ahead. Okay, so it's just a matter of what the markets give you. Now let's talk about the stop loss, right? So if my average entry, let's just do another one. I'm not going to sit there and calculate it, but let's say my average entry for this one was right around here. Average entry for this one, only entry, right, is here. These two entry points are going to make a big difference where I set my stop loss, right? Because if this guy takes off, I want to make sure that I preserve my reward to risk ratio, right? So let's rephrase this a different way. Let's say every single order got filled. Right, my break even is right here because that's my average price. So everything over here is profit. Now, where would be a good stop loss? Anybody want to take a guess? So again, I'm talking about the blue trade. I've entered everything. I'm really heavy.
The bottom third, I guess, right? Or
exactly.
Just below it, right?
Exactly, just below it, because as you see, these little fuckers tend to wick you, and we call that a nut flicker, right? Where it basically comes down and just barely touches your stop loss and then bounces back, right? So there's a tool in TradingView where we can actually have it calculate it for us, right? Right, so this is basically going to tell me when I'm in the red and when I'm in the green. And if you look, it tells me my risk-reward ratio is 2.74, which is pretty good. You typically want to aim for at least a 2-to-1, right? Whatever my reward is should be twice that of my risk, ideally 3, but 2.7 is pretty good. If I enter everything in this trade right here, let's say that this was in the third, that's a 1. Now all of a sudden everything changes, right? And I'm giving myself a lot less room to work with because I was too hasty. Does that make sense? So if I bet it all on red, so to speak, and I enter this long, instead of it being a third, it's everything, right? Well, now the whole thing shifts up, and guess what happens to my risk reward? Close down a little bit. Okay, same trade idea, right? But now look at my risk reward ratio. It's 1.7, 1.74, right? So I have to shoot myself in the foot, so to speak, because I'm hasty. Does that make sense?
Yeah.
Okay, cool. So my whole little aside here is talking. I'm going to bring this all together right now, right? So we have a theory that the Bank of Canada may cut rates, right? What does that mean for stocks? It means that they're going to go up. Okay. What does that mean for us as traders? We want to take advantage of that. How do we do that? Right? Go ahead.
As you're saying, go along and right on it.
Well, of course we want to go long on it, but the question is where, and where do we set our profit targets and stop losses? So the option is we go market and just say fuck it, and with high probability have to hold it underwater for a while, or we can stack our orders, right? Buy at these levels, or instead of this being a third and this being a third, I can just say, well, all right, I want to put 100% of my order here or here, right? There's a couple different options to it. I like the ability to add if it goes down, but again, I'm not adding because I freaked out and I'm hitting the buy button. I'm adding because I planned, right? Does that make sense?
Yeah.
Okay. Anything that's not clear, please stop me right now. But if you guys are okay on that, we can move to the next trade idea, which is bonds. Okay. And I'm going to take a look at this one first. And I haven't even drawn any technicals for this, so we can go ahead and do that. Anybody have an idea of where I'd want to anchor my Fibonacci's? Let's do the Fibonacci's first. Any ideas?
I'm gonna guess here, 1590.
Okay, 15.
You're right.
90. Okay, and the other anchor?
Let's see.
1640 up here at the top.
40, yeah, 40. Yeah.
Cool. Okay, that's a great idea. And if I do that, that's going to give me a bunch of levels in between, right? Perfectly viable. Okay. Problem is, look at where we are. Come on. Look at where we are now. We're here. So if this busts through this level, these levels here don't really help me too much, right? Now, let's back up a second. ZAG is an ETF. Remember what ETFs are. ETFs are an aggregate of things, right? Whether they're bonds or stocks or whatever. In this case, they're bonds. This is the most liquid ETF bond contract for Canadian, the most liquid ETF for Canadian bonds, the BMO aggregate. It's composed of corporate bonds and government bonds and all that. So if the Bank of Canada lowers rates, what do we expect that to do for bonds?
Down.
So we have the difference between bond yields and bond prices. What is that? Or the correlation, right? When bond yields go up, the price goes down. And that's not, and vice versa, right? So when the yields go down, the price goes up. So when what is the relationship between bond yields and the interest rate that the central bank sets?
Well, when interest rates go up, you'd probably have a bigger yield.
Exactly. So when interest rates go up, bond yields have to go up, right? Because the bond yields are always, that base level that the central bank sets plus, some padding for depending on the maturity, and it's complicated from there. But, so suffice it to say, when the central bank raises interest rates, bond yields have to go up. Okay. So what does that, so when when the central bank cuts interest rates, what does that mean for yields? They have to go down.
Bond yield goes down.
Exactly. So what does that mean for the price? It goes up. So this is one of the only times you'll ever see bonds, the price of bonds track stocks or move in correlation, right? Because they're good for that asset for different reasons, okay? With stocks, it's because the borrowing rate goes down and money becomes freer, it becomes more easy, right? With bonds, it's because fundamentally the yield is going down, which means that the price goes up in tandem. That's just how it's calculated. So they move in the same direction for different reasons, all right? Usually bonds and stocks, how do they behave with each other? You guys remember?
Well, they're kind of opposite, right?
Exactly. Why? Because that's the fundamental thing you guys got to understand in trading is risk on versus risk off. Okay, so when we're in...
Yeah. I would say that, like, if the interest rates are higher, it's people want a more safe investment, so they probably lean toward the bond, right? That's not entirely, that's a little bit too simplistic. I mean, I see where you're going with the logic and I like it, but that's unfortunately, it's a little too simplistic because in the 80s, interest rates were double digits, right? And the volatility, people would trade bonds like crazy, right? When you have high interest, when you have high yield bonds, people want to get into that, right? That's why they're having so much problems in Europe. For example, the Grecian bonds used to pay like 13%, whereas the Bund and the Bobble and whatever they call their bonds over there, they're paying like they still pay like 0 or even negative, right? So if both countries are in the European Union and both countries are essentially risk-free, why would I buy bonds from Germany that don't pay me anything when I could buy bonds from Greece that pay me 13%? It's part of the reason why Greece has so many debt problems, is because it just poured money into them because of that. But it's a historical example. So anyway, my trade sentiment toward this product, the BMO Aggregate Bond Index ETF, because I'm bullish of bonds at this point, because of the logic that I gave you, we expect it to go up, right? Now look at what it's been doing lately. Why is that? Why has it been tanking? Interest rates going down?
Okay, there are two things you have to understand when you trade bonds. One, yes, you hit on the interest rate part. Interest rates, there has been no interest rate decision yet. I don't have it off the top of my head. I'm sorry. The next meeting of the Bank of Canada is soon. I don't remember when it is. But they only make their rate decision meetings, or sorry, their rate decisions at very specific times. Okay, so it wouldn't be a central bank thing unless they made some announcement, which they haven't. The reason why bonds are tanking right now is because currently we're in a very risk-on environment. And this gets me to the discussion about what it means to be risk-on versus risk-off. Okay, when I have a risk-off sentiment in the markets, that means people are freaking out, sky is falling, war, blah, 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 everything, Armageddon, all that. So what they do is they put their money in the safest place possible, which tends to be treasuries, right? Bonds in general, but in particular, treasuries, treasury, bills or bonds from a country like the US or Canada or something like that. Okay. So when you have a risk on environment, that means that investors feel that that for a given amount of risk, they can get a reward, right? So if I take action on a risky product like stocks, that means that, and I have a risk on sentiment, that means I feel it's worth it. Okay. So I'm willing to put on a trade, risk a certain amount because I feel it's gonna take off. What that means for bonds, again, they're inversely correlated. So when I'm risk off, people take their money out of stocks and put them in bonds. We see institutions do, and that's who you really care about. When I'm in a risk on environment, the opposite is true. So currently, because the data points have been admittedly very good for Canada, even though we believe long-term bonds should appreciate because of this impending interest rate cut that is inevitable. Currently, because of those two factors, again, we have the central bank interest rate decisions and risk on, risk off sentiment, right? Because we're risk on right now, we see the price just plummet. Now, what does that mean for us? Okay, as traders, if I feel that long-term, I'm just gonna draw the Fibonacci's that I had in mind, and it's Ross, right? What was your name again?
Tim.
Tim, okay. Yeah, you had a very, very good suggestion for the Fibonacci's, because your suggestion is going to give you ideas for profit targets. Let me get rid of this real quick. Right? Because let's say if I was to buy here, I could take profit here, take profit here, take profit here, or understand where I might expect some resistance. Let's say I don't want to take profit. I'm waiting, I have I'm full throttle on this trade. I want to see it retrace this entire range, which it will. You'll see. I can expect resistance at all of these points. Okay, so your suggestion is good, but maybe I should rephrase the question a little bit, because I'm trying to set these Fibonacci levels to determine entry. Okay, because I want to get a good price, and I want you guys to do so as well. Not just in this trade, but in any trade you take, right? Because what we're looking at is not necessarily this particular trade. It's about the process, right? So if I feel that one of my assets is going to appreciate and go a certain way, I want to make sure I get the best price for it. Okay, so what I'm going over here is are some ideas on how to do that. Okay, so you see, I'm in this incredibly risk on mode for Canada, and I'm seeing some resistance here. Right, we will see some resistance. Canada didn't quite make it. We can expect maybe that we're going to break down even further. Now, what do you call an area? Let's try this. What do we call an area like this? Anybody remember? The space in between these Fibonacci levels.
No idea.
It's called a vacuum zone.
A vacuum zone.
Right, and why is it called a vacuum zone?
So there's no support and no resistance there. Just go
Exactly. So if the price breaks this level, what can we expect it to do?
The chain to hit the resistance down.
Right. Right. So if we break this level, we can expect it to maybe test this level right here. Okay, and that's the whole reason why I drew the Fibonacci's this way, is to get a feel for that. Okay, so based on that knowledge, where do you think might be a good entry point?
Just waiting it bouncing from the zero on 1589, then we entry that point, I guess.
Well, we can wait for a bounce here, but what's the risk there?
It can be retest again on that 618.
1580.
So sure, we have the 1581, the 1580 level right here. But remember, we have this vacuum zone and we have a lot of momentum here. So if this level holds, great. But if it doesn't, what do we do? And
Add a stop.
yes, you can add a stop, but I'm not even talking about I'm only talking about the entry price right now.
So waiting until 1569.
Exactly, that's what I'm looking for, right? Because if we break this, right, we're definitely going down to touch here, right? And this agrees. If you see there's some congestion here, the way you can test your Fibonacci levels if you did a good job, there's two ways, right? Well, there's a lot of ways actually, but number one is that they kind of agree with what your asset is doing, right? So the one that Tim picked is a very good example of some very successful Fibonacci's. Why? Because they identify these gaps very well. They identify the relative highs very well. Okay, over here too. All right, same with the ones I did, right? I had no knowledge of how this asset was behaving or anything like that, but already my Fibonacci's identified some congestion here, a relative high before a pullback here, another one, and so forth. The other way you can identify if you've done a good job or not is if there's some agreement, right? So you see here, these two align pretty closely and these two align pretty closely. And pretty closely is kind of like an air quotes kind of thing. You kind of have to understand how long of a time frame this is, right? And understand that, you know, the difference, there's going to be a little difference, but here it's not much when you take into account the time that I've over which I've drawn this. Okay, so my whole point in going on that little aside there is that I see that 1589. This is a 4-cent difference, but it's a pretty significant level. Okay. Anybody see any other technical patterns we might identify that may support the idea that we might break down into this vacuum zone here? I'll give you a hint. It's this structure right here. Anybody? All right. Well, notice that we have these kind of rise and runs here, which form this little zigzag type of shape. Have you guys seen this yet?
Not head and shoulders.
No.
Yes, it's a head and shoulders. Very good. All right, so if we can draw that in TradingView, there's a little tool for it. I'm looking for it. Let's see. Can never remember where it is. Yeah, here. There we go. So if I draw the head and shoulders, right? Come on, there we go. Okay, so now it's a little easier to identify, right? And why is a head and shoulders pattern relevant? Right? The reason is because the market made an attempt to go higher and then it turned it down. The market made a successful attempt to go higher, turned it down. The market made a final attempt to make highs and then it was unsuccessful. Okay, so what that means is that I have a rejection of the ability to make new highs. Now, this doesn't always mean that it's going to go down, but our concentration is on the neckline, right? The neckline and the head and shoulders. Oops, let me change the color. Red. No, I don't like that red. This one, yeah, brighter. There we go. Okay, so this is the neckline. Okay, why is the neckline important? Well, it's a significant level, right? And it's formed because we have a consistent level that's being tested, right? Anytime you see an asset flirting with a particular level, it becomes important, right? And there's lots of reasons for that. It has to do with liquidity and all that. I'll save that for another lecture. But the point is, this neckline is important, right? So we can either do one of two things. We can bounce off of it. So you guys both suggested 1589 might be a good entry. I agree. However, we have to be very, very vigilant of this neckline, right? Because if we don't bounce off of this, right? So again, I'm going to do the little, the arrows. Are you guys with me so far? Does this make sense?
Yes.
Okay, cool. All right. So red is your guys' idea that it may bounce off this neckline, and let's do. This is another idea. Let's do blue again. Okay. So again, if we're right and long-term bonds are going to appreciate for the reasons that we suggested, we want to take advantage of that. Where do we do it? You guys had a good idea to take advantage of it here, and my suggestion is, all right, maybe we can do that, but we can also hold out or add to the position here. Okay. So if we're right, we take. If you guys are right, let's take one position, and let's. What we can do is set our risk reward, let's say about half the channel width, because that way we mitigate the nut flickers, right? Because if it does inch down and it goes halfway, we could pretty much bet that it's going to retrace the whole thing, right? So we have a risk reward ratio of 5.3, not bad, not bad, but we're gonna have to hold this a couple of days, right? Because this is going to take some time, and we're going to have to wait for the interest rate decision to really take advantage of this trade. All right, let's check my idea, right, which requires us to be more patient, but that's okay. I typically, again, you want to set, if you trade off Fibonacci levels, it's a good idea. This is just a pro tip. You don't take it or leave it. If you set your stop loss about halfway between the channel, you could pretty much be certain if the price goes that way, it's going to retrace the full thing. Does that make sense? Right? Because we're in a vacuum zone, right? Okay. And then I have the same profit target, but look at the risk reward on this is not, oops, the risk reward here is 9. Okay. So very good opportunity to make even more money. Again, I'm going to have to hold that trade even longer because it's going to take time for this thing to fall and then to bounce back. But the whole point of this aside here is where you can enter, where you can set your stop loss, and where you can set your profit target. Does this make sense?
Yes.
Okay, cool. The fourth
question for you here.
Go ahead. I'm sorry.
So, for example, is my strategy, I will put 50% as 1589, and then put another 50% if it go down to 1569.
Yes, absolutely. And that's what I was going to get at next. So if you wanted to do that, your average entry point, let's draw that, would be somewhere, you know, it would be basically where my stop loss is for the first trade. Okay, so let's change the color here. Okay, so this is the third trade idea that Ty had, where instead of just doing one or doing the other, we do a combination, in which case we have our entry point here. If we do that, we can be a little bit more stingy on our, we don't have to hold, even if we did, that's fine. We can hold it to the middle there if we wanted. And we have basically an average, but so, okay, so we have 3 trade ideas. Let's make this a little, we have 3, oops, come on. Okay, so we have 3 trade ideas, right? 1, 2, 3. This one is super aggressive because probably, yes, we will will eventually touch this Fibonacci level, which I've drawn here in red. We have the more conservative, which gives us more risk reward. But also there's two things. There's a certain thing you have to consider when you're with your entry is the probability of getting filled. If I put my entry like way down here, I mean, the chances of this thing retracing all that way, I mean, it could, but probably not. And if it does, that's going to be like 1 in 100, right? You want to make money, you want to trade, you want to have something realistic. Okay, so this is a realistic entry point, but it's a lot more aggressive. It's a lot less aggressive than my entry point over here where I'm on the neckline, which almost certainly will be tested. Okay, something in between is to stack them, right? So if we go, I know it's kind of hard to see because I have all these technicals here, but if we go the way of the red arrow with 50% of our trade, right? Well, it's better than nothing. If we go, if we retrace all the way down here and get filled here as well, we still have the same risk management. Okay, we have a little bit less risk reward ratio than this guy over here at 3.6, but that's still pretty good. Okay. So questions on that? Does that make sense?
Yes.
Okay, great. Now let's take a look at this ETF right here. All right. This is also a bond ETF, but this is very, there's something very special about this versus this that I want. Let's clear these away. Get rid of all this crap. Okay, so I have this thing, and then I have this. Notice very similar head and shoulders pattern. While we're at it, we can go ahead and draw it. All right. Now notice that we had this breakdown here, okay? I'm gonna give you one fact about this is that this, the one we just looked at, was an aggregate of bonds, which it tends to be more heavy on the long side. And this is a very fine detail about bonds that I'm getting at, but it's very important that you know this difference as a trader. And then we have this, notice this keyword here, short-term bond index ETF. This is composed of mainly short-term. What do we consider short-term? Well, it's anything south of like 5 years. Typically, 5 years and below. That means if I buy a bond, a 2-year, its maturity, or when the bond is has reached maturity, is in 2 years. With a 5-year, it's 5 years, and so on. Those are considered shorter or short-term bonds. Long-term bonds lock your money up for a longer period of time, right? 10, 20, 30 years, right? And they react differently to central bank news, right? Does anybody know how they do that? How short-term bonds react to central bank expectations versus long-term bonds? Anybody want to take a guess?
Can you repeat your question?
Sure. So let's say the central bank increases rates, right? So they have a rate hike of say 25 basis points. Who is going to react more to that? The long end or the short end?
The long.
Long.
It's the short. And you can see it right here, right? Because the big fact is that as Canadian data points get stronger and stronger, the expectation for the Bank of Canada to lower interest rates becomes less, right? So here we see how the longer term reacts versus the shorter term. Proportionally, it's more. This caused this to break this head and shoulders pattern. Why? Well, because longer term bond maturities care about everything, the set of all things that could possibly happen in 30 years, right? Central bank news for one quarter, or sorry, for one meeting, in 30 years, there's a lot more stuff. The 30-year bond, I'm just using 30 years as an example, the 30-year has to care about. What the 30-year cares about is like things like inflation, because inflation gives us an idea of where we are in the economic cycle, which the 30-year really, really cares about. Okay, the 2-year, right, or even below, sometimes, you know, there's 1 month, 3 months, 6 months, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 20 and 30 for the U.S. Treasuries, and then you have tips and things like that. But anyway, if you look at the shorter end of the spectrum, okay, those really care about the central bank news, because that's pretty much all they have to care about, right? Because they're so short that the only thing that really affects them is going to be those central bank rate decisions, right? So it's a very, very important take-home point when you're trading, is to understand how the central bank news and the central bank statements are going to affect bonds, right? And why do we care about bonds? Because bonds drive the economy. Everything every currencies, stocks, or whatever are all driven by bonds, because bonds are where the smart money is at. And as a trader, if you want to have something to really focus on and really learn more about, it's going to be the bond market. So I picked this example very specifically because that is a very good example of this fact. The fact that central bank expectations of a cut have been reduced. In addition, we have a risk-on environment, right? So we have bonds are tanking generally, but they're going to be hit more on the low side. Does that make more sense now? Really the take home of this is because the shorter term bonds, the only thing they have time to care about is the central bank decisions. Whereas the 30-year and the longer term bonds have years that they can price in other stuff. So one tiny little central bank decision isn't really going to affect them as much. Does that make more sense now? If you guys need more words on that, please, by all means, let me know. I'm here for you guys, not to hear myself talk. I'm kind of a narcissist, so I do love to hear myself talk, but I'm really here for you guys. That was supposed to be funny, but all right. All right. So Chen is another bond guy. So if my explanation of the long and short end isn't making much sense, it kind of shouldn't, right? Because it's a very, very complex animal, right? And it's something most people will never have to deal with in their entire lives, with the exception of maybe getting a mortgage. That's really the only time anybody is going to care about what the 30-year bond yield is at, because that's what mortgages are based off of. They're calculated on that, and the federal funds rate from the U.S. is the context there. But so the fact that this is a difficult concept for you, I mean, it is, right? I'm not going to lie. It took me years to get this, but you got to start now, and you have to analyze charts like this. Ask yourself, why did this happen? What was causing this? What were the technicals and what were the fundamentals, right? It's not easy. Trading is not easy. It's not for everybody. But if you master these concepts, guaranteed you're going to be successful at it. Guaranteed, right? So let's get into some trade ideas for this. We see that it already broke, right? Now, what does this mean for our other trade? Well, if this chart broke, and bonds continue that way, that means that we have a pretty good probability that this is going to break as well. And we've already made our trade setups for it. Okay, but going back to this one, right, we could basically redo the same analysis. I don't mean to, you know, beat a dead horse or whatever the saying is, but you know, hopefully we don't have any PETA people in the audience. Actually, hopefully we do. I love offending people. I'm American. So, you know, we could set our entry price. That's pretty much where the close of today was at. So we'll be effectively entering at market. But, you know, if, you know, I can't really see the details of this, and we're speaking high level anyway. So we could have an entry point here. Maybe another idea is, so maybe we could put it on the second Fibonacci, right? Or again, as Ty mentioned, with the previous trade idea, we might be able to take an average, put 50% of the trade here, 50% of the trade here. Those are just some options. Does this make sense?
Yeah.
Okay, so again, just to recap, we expect eventually the central bank is going to lower interest rates, which means that bonds are going to go up. And what we're doing right now is trying to figure out, as traders, how do we want to make money off of that? How do we want to set up a trade where we can be profitable from that and manage our risk properly? And that's pretty much the whole what I've been going on about tonight. Okay, any questions on this? All right, let's talk. Yeah, go ahead.
This is a bond, but is there any dividend or any yield that doesn't show on the trading view chart?
Okay, yes, we can take a look at the yield, for example. Okay, so each yield has its own symbol. I know for the, let's take a look at US 02Y. This is the US government bonds 2-year yield. Okay, and this is very important, you know, as you're trading, to understand the difference between the 2-year, right, and, for example, the 30-year. All right, you notice they're slightly different, but in general, they track the same. Okay, and the differences between these two yields constitute what's called the yield curve. Okay, and that's going to be a separate lecture. I love giving that lecture. If Chen gives that to me, I'd be super happy. It's again, one of these fundamental aspects of trading in the economy that really drive your trades. Okay, but suffice it to say that yes, I can pull up what the yield is on this. On these individual ones, you know, this is, oops, that's the TSX. This is the, remember, we're not looking at the bonds themselves in these two guys. We're looking at a basket containing short-term bonds and a basket containing long-term bonds. So having a yield on something like this from the individual bonds doesn't really make sense because there's so many of them. However, because this is an ETF, remember, it trades like a stock. And stocks sometimes have dividends. Oftentimes, the ETFs do carry dividends, especially if it's a fixed income product like that, because they're getting it anyway. They're going to pass it on to you. And for that, you just go to Yahoo Finance and look it up. But there's no like chart symbol on TradingView for it. Does that answer your question?
Yeah. So okay. You mean the trading view doesn't show the dividend or the earning?
No. Sometimes they have. Sometimes they do.
They do on the stock. I know.
Yes.
But
Yes. Exactly. ETF. So see here, if I pull up Starbucks, it'll tell me
earning. Yes.
But they don't appear to do that for the ETFs. But you can go on Yahoo Finance and just type in these. I can pop them into the Discord so you guys have it, and you can look it up, you know, to determine if it has a dividend and what that dividend is.
Okay.
So the other one, I wanted to pull up today. Looks like we're probably going to spend the whole class on this. I do want to get into chart patterns, or sorry, the trading setups. So we're going to try to go through pretty quickly the S&P. So remember I told you guys earlier that there were three really big things that the markets were concerned about today. That was Brexit, that was Canadian data, and that was the trade stuff, right? All of which are very bullish for stocks, right? Because any type of trade resolution, obviously that's good because, you know, there's all this uncertainty with the tariffs and all that. Canadian data, you know, just by way of North America, it should bleed into the U.S. indexes somewhat. And then, of course, you know, Brexit, once Brexit is finished, then the UK is free to, you know, negotiate, you know, their trade policies with other countries, which is going to be good for the economy. So there's a lot of other finer points too. But if we look at what happened today, we see that basically stocks just took off. They hugged 3,000, which is obviously a very important psychological level. Because it's a psychological level, it's basically become a technical level as well. And it kind of retraced a little bit here, but we really were off to the races here in the morning of the North American session. So what we can do is take a look at this guy as a whole and think of some trading ideas. Okay, so keep in mind that we've, you know, ascended quite a bit here, but we also have to take into account the longer term. Okay, when you trade, you should always be looking at a short, medium, and a long term. Typically for me, my long term is day, right? My medium term would be 30 minutes, right? Because we can get an idea of these, you know, these patterns, like what they look like in detail. And then when I want to actually go through and place my trade, I can look at something like the 5 minute, right? Which is pretty detailed. You typically don't want to do anything less than that. If I do like 1 minute, it's just too noisy. And it's not really, it doesn't really help you very much. Like the information I get off of this is really not that much more than what I get off of this. That's just me. But, you know, it's everybody's different. I have a buddy who prefers 3 minute for the short term, 15 minute for the midterm, and like 4 hour for the long term. That's perfectly fine. You know, he's successful doing what he's doing, so that's great. So just keep that in mind, that when you're really looking at these technical patterns, you may want to you know, try these different time frames. So can you guys tell me again? We see some levels here because obviously this is something I look at a lot. Can you guys tell me any technical patterns that you see? And it's okay if you don't, because this one's a little kind of a little challenging, right? But and we may have to dig deep to make the, you know, to kind of force something to work. But you know, if I'm drawing a trend line here, and we notice that I have these highs here and here, we may have another one here. What does this start to look like? Have you guys covered bull wedges?
No idea.
No.
Okay. Well, that's probably why it didn't make sense. But this is what we call a bull wedge, or it's a bull wedge in formation, right? And a bull wedge is defined, and I'm going to actually get to that immediately after this example. So if it's not quite clear from this graph, don't worry about it, because I have a module on these. So anyway, a bull wedge is, you know, we have this hard upper bound here that keeps getting respected. And that hard upper bound is right about 3017 or so. We were just flirting with 3000. If we could break through that, there's a pretty good chance, as you see things in perspective, if we can bust through here, there's a pretty good chance we're going to test this again. Okay? So if that's the case, right, we're going to have this meandering back and forth I don't know if you can see my cursor, but this meandering back and forth between this upper bound and this lower bound here. And what that amounts to is kind of like coiling up a spring, right? This side keeps increasing, but this side remains the same, right? So this, what does that mean for the volatility? The volatility is consolidating, okay? And whenever you consolidate volatility, it always wants to revert to the mean, right? So when you consolidate and keep it pressed and compressed and compressed, eventually it's going to burst, right? And with a bull wedge, the probability is that it's going to bounce to the upside. It's like 60-40. Sometimes it rejects and goes down. Much of the time it skyrockets. My personal take, again, this is just based on my fundamentals and all this, is that stocks are in a very good spot right now. Because again, the pendulum for trade sentiment is in the green. We have a very easy monetary policy situation right now, and that's not going to change anytime soon. Only problem is we have some shitty data coming out of the U.S., but typically that comes in phases. I don't think we're at recession time yet, so I think that we can anticipate some teetering back and forth and eventually break out from highs. So I have technical reasons and I have fundamental reasons for this trade. So where might I want to take advantage of an entry? Well, we can set our Fibonacci's. We could do it here. Now, the reason why I selected this area as opposed to going out really far back here is because we've been making increasingly higher highs, right? So the probability of me retracing all this way is pretty low. The probability of me breaking down even further is even lower. So I don't need to go back this far. I could pretty much just go with the levels I've drawn. These go back in time. I don't really remember why, what particularly made me draw those, but it still obeys them, as you can see. And we have a pretty decent agreement here between how I've drawn my levels and my Fibonacci's, which means that they're reliable. So we can consider these for some trade ideas. Okay, and again, it depends on how long you want to hold this, but you know, we could go through the same logic here of maybe picking when I see a Fibonacci level agreeing with one of my technical levels, as you see here with the overlap of the white and the red. That's a very strong level, and we're probably going to test it again. Also, I have this trend line. If I'm right and I see a bull wedge pattern form, don't worry if that again isn't making a whole lot of sense, because I'm going to talk about it in a minute. What that means is that I can expect it to do this type of thing. All right, let's extend this. Oops. So you guys following so far?
Yes.
Cool. Okay, so what that means is I can expect it to do extend this here.
Okay, your chart has many lines.
Yeah, I know my chart has many lines. Let me clean that up for you real quick. I'm just gonna keep the relevant ones, okay? I don't mean to confuse you guys. It's just this is something that I trade every day, and I took this lecture on pretty short notice, so I wasn't able to prepare as much as I'd like to. So sorry about that, but. We have the take homes that I want you to take a look at are these Fibonacci's, this trend line, right, and this upper bound. Okay, so this trend line here forms what's called the lower bound of the bull wedge, and you know, again, I'm going to get to this in a second, but all this teetering back and forth, it seems to bounce off this trend line. It's like it's building pressure. Think of like pushing a spring really, really hard together and then letting it go, right? It kind of, you know, goes nuts. And then we have this upper bound here that's pretty consistently respected. Okay, so this is what I anticipate is going to happen, right? So what does that mean? If I anticipate it's going to touch this trend line, guess what? This trend line is fairly close to this Fibonacci level right here. That could be a good entry, right? Then I have this Fibonacci level right here as well. That could also be a good entry. Okay, so this is how you would use that to kind of set up this trade. And if I'm wrong, well, that's fine. If I break this trend line, significantly, like let's say I breach this territory, maybe go down here, then I no longer have a bull wedge and I know I'm wrong. If I don't, right, if this reasonable retracement happens, that's just going in line with the bull wedge pattern. Okay, does that make sense?
Yes.
Okay, cool. So Tim, you've been quiet. You still with us?
Yeah, I'm trying to listen. I got a short attention span, so
Oh, okay.
I'm actually in a little bit of pain right now. I had a jaw surgery there, and I'm still swollen up.
Oh yeah, I've had 9 reconstructive surgeries, so I know
Oh, yeah.
jaw pain very well. That's what 20 years of Muay Thai will do.
Oh God. Yeah. Well, hopefully you won't need it again.
Probably will, but that's all right. I'm no stranger to pain. All right, let's jump into trading setups. In fact, since we were talking about, let's see, what do I want to do? It doesn't work. I'm trying to jump to the, oh crap. Doesn't look like I have it in this one. Maybe I do. Okay, here, yeah, I do. So here in this module, this is really, if you're a technical trader, you really want to take a look at this module. I'm going to see if I can present it to you guys at some point later, because this tells you what all the technical patterns are. I mean, not all of them, but you know, the ones I use, and where you want to get in, where you want to get out, ideas for all these different setups. But since we were talking about bull wedges, and I'll cover head and shoulders too, because I have a whole bunch of examples for that. Okay, so we're going to talk about wedges, right? And that's just because we were, you know, it makes sense because I saw one there and, you know, we were going over it. So let's really hammer this, okay? So wedges represent what's called consolidation of volatility. And if you remember what I was saying earlier, when you compress volatility, there's only 2 things that revert to the mean, right? Can anybody tell me what those 2 things are? That are guaranteed to revert to the mean. And price is not one of them, because the price can skyrocket, it can collapse, it can hang out in a range for a while and then just completely blow up in your face. It does whatever it wants. But there are 2 things that are guaranteed to revert to the mean. What are they?
No idea.
Well, obviously, I'm talking about volatility. So volatility is one of them, and momentum is another, right? So if I have a stock or whatever that's just fucking blasting off, you know, a lot of momentum, I can expect that somebody's going to ease off the brakes a little bit, and we're going to consolidate, right? Same thing with volatility. If volatility is being compressed as it was as it is here, eventually I can expect a breakout in either direction. Okay, and that's just how it works. And a lot of these trading patterns are based off of that concept. Okay, so just like with the head and shoulders, I'll get to that more in a second if we have time. We want to focus on this horizontal boundary. And what I mean by the horizontal boundary is this guy right here in the bull wedge, or this guy right here in the bear wedge. Okay, so we put, there's different ways to trade it. You could put a stop order on the breakout. You could put a limit order on the retracement, or you could trade what I call the first bar of conviction. I know I'm saying a lot of things to you real quick, but I'm going to give you some examples of that here in a second. So again, a bull wedge is, you know, the horizontal boundary is here. We have the lower bound gradually increasing, gradually building up that strength, building up that pressure, like compressing a spring. And here's a good example. This is Bitcoin. I used to manage a fund for cryptos back in the day, and so traded a lot of cryptocurrencies. And this is something that we can expect from those days, right? Where we're respecting. This was obviously, you could tell how long ago this is. This is 480 roughly with Bitcoin, bouncing around here. And then eventually we have this pretty emphatic breakout here. So that's an example of a bull wedge in real life. One second. I was Chen, just seeing how we're doing. All right. So we have, okay, that's just an example of of a bull breakout in the wild. Here's a bear wedge. Whoops. So we have a bear wedge. It's just the opposite, right? I have the price kind of going down here, testing this lower level. It's kind of bouncing around back and forth. Let me see. Somebody else wants to join. Let me see. No, we're running out of time here. Oh, that's right. I'm recording it anyway, so that's good. All right. So, where am I? All right, so bear wedge, basically doing the same thing. We're testing this lower bound, volatility is consolidating here. We can expect a breakdown, okay? And here's a very good example of that. I know some of these are kind of a little, you might not see them at first, but the key thing you want to take advantage, or you want to take note of, is the lower, consistently lower highs hanging out about this level right here. And in fact, we do see this nice breakdown here. So does this make sense in concept what these things are? So basically, again, you're just looking for this trend line and this horizontal boundary here. So when you want to go through and trade these, there's three ways you could do it. You could trade with a stop order on the breakout. Do you guys know what a stop order is?
Yes.
Yeah?
No.
Okay. So a stop order, there are four types of orders that you can place on the exchange. There's actually a lot of them, but for your purposes, there's only four, because unless you're actually a programmer, you won't have access to the others anyway. And each of those is used for a specific purpose, right? So stop orders are different from limit orders, are different from stop limit orders are different from market orders. Those are the four types: market, limit, stop, and stop limit. So if you don't understand what those order types are, this part of the module isn't going to make too terribly much sense, but I'm going to jump to the point which will, right? Remember when I told you guys the possible entry points are going to be here, here, and potentially on the breakout? Well, basically that's all this is saying, is that if I feel I'm in this bull wedge pattern, I'm going to put a limit buy here. You guys at least know what a limit buy is, right? Where I place an order, the asset is trending somewhere up here. I want to get at least I want to get the price that I requested or better. Okay, so it's not guaranteed to be filled, but if it does get filled, I'm going to get the price that I want, as opposed to a market order, which is just wherever the fuck I get. Okay, so we retrace here. If I have this buy, I'm going to get filled. All right, and then I'm expecting this thing to continue and eventually break out. The other two are just, there's a little bit more advanced examples on how to do that, or how to take advantage of this structure. And I'm going to talk to Chen and see if maybe I could get some more time with you guys to go into that, because these are fairly important on how you want to, on the ways you could take advantage of this. So similarly for the bear wedge, again, a bear wedge implies that the market is going down. It's implying that it's going to break it down. Okay, so don't worry about the stop. Basically, the idea here is the same thing as the bull wedge, but in reverse. Okay, so if I sell here on, again, I'm focusing on the trend line for my entry price. If I bought on the bull wedge here, I'm going to want to sell on the bear wedge, right? So I have a limit sell right here, and that's how I enter the trade. Okay, so questions on that? Does that make sense?
Yes.
Okay, Tim, you still with us?
Yeah.
Okay, cool. All right. Then the last one we are going to cover is the head and shoulders. Let me try to find that real quick. Okay. And I think this is probably enough material for you guys tonight. I know this is probably like learning out of a fire hose, but I hope you found this material interesting so far and maybe learned a few things. maybe not, but you know, I had fun. So
Yeah, no, it was good.
cool.
You know what? After about an hour and 10, I just sort of pays out. Like, it is a lot. So.
No, I know. And in the past, I would give breaks, but I would have 3 hours to work with. So I'd give you guys like a 15-minute break. Now I only have 2. And I'm pretty much just going here. I've been working with this stuff for years and years and years. So for me to talk about this is just like, you know, I just kind of go, you know, it's like, I like this stuff like Catholic priests and little boys, right? So this is my thing. So I can just go on this for all night. So if I'm boring you guys or you need a break or whatever, it's kind of, I see you got it. just sit in. But anyway, I could go on this all night. So if I'm going on, you know, rambling too much, well, that's just me. Anyway, okay, so head and shoulders. I touched on this a little bit when we were talking about that bond trade with the Canadian bonds. So we have failure to make new highs. You want to focus on the neckline. We talked about that. And these are just ideas for where to set your stop loss. And in order to understand these with the previous bar, significant levels, all that, we kind of got to go through and just see what the head and shoulders looks like. Okay, so I have this bouncing back and forth, gradually making new highs again at the head, and then failure to do so on the right shoulder. Okay, all kind of the agreement here being the neckline. Okay, that's what these 1, 2, 3, 4 characteristics is really what defines the head and shoulders pattern. And we see how bearish this can be. Okay, notice that the neckline does not need to be completely horizontal. It can be a little bit slanted, all right? But we still have this left head, right shoulder kind of pattern. And what we want to look for is not just a breakout from the neckline, but an emphatic breakout like this. Okay, head and shoulders can be inverted. Okay, we used to call this the dick and balls pattern. Okay, so we have the left shoulder here, the head, the right shoulder, and we have this nice breakout over here. Make sense so far?
Yes.
Okay, cool. Again, this is another example. I used to look at a lot of stocks, so we have this with United States Steel. Notice that, again, we have this neckline here and a nice breakout with this solid green candle followed by these guys, and it pretty much just goes off to the races. Okay, makes sense so far?
Yes.
Okay, so again, the neckline may not be horizontal. We may have a slope. So here's another example. As you saw from earlier, I look at oil a lot. This is a great example. Oil is fairly obedient to the technicals, but the problem is it squeezes. That's a different conversation. I could give a whole course on just trading oil. But we have this pattern here, and again, a breakdown. So the key question is, you know, anybody can sit there and tell you what these patterns are and all that, but the key to actually making money off this is how to trade it. Obviously, that's our job, right? So to do that, you want to focus on the neckline. So what you can do is put a stop order on the neckline. And basically a stop order is something that gets filled almost instantaneously, as opposed to a limit order, which tries to get you the best price, or the market order, which fills when it fills, right? Stop orders are called stop orders because they have, they get priority on the exchange. And the reason is because they're used for stop losses, right? So if you want to get the fuck out of a trade, you got to get the fuck out now. Okay, so the exchange, there's a lot of regulation on how they treat that. Okay, so you can also use them to enter, as I'm suggesting right here. We have the risk can be high though, because you are subject to slippage. Okay, so just because it gets you in immediately does not mean you're absolved from the risk of slippage. Like in the market order, it tends to be a little bit better, but it's still, you have that risk. Okay, but your chance of getting filled is very high, because as soon as the market hits it, you're in, right? Or you can look at the limit order on their tracement. I'm not really going to go into that one. So basically, you're focused here on when this asset breaches this neckline, and again, you want to be very, very diligent to make sure that you have momentum, right? Because I'm going to go into some examples where you have volatility, you can have wicks, right? A lot of these examples, especially with oil, actually here it didn't really do it, but typically, yeah, you see with United States oil, we have, or sorry, United States steel, we have these nice wicks, right? We don't want to get in on the wick, right? Remember, that's nut flicker. You don't want to get in on that. You want to get in on an actual momentum. Okay. Okay. So, and here's another important point regarding the head and shoulders. You know, we're kind of getting low on time here and wrapping up. So we want to wait for the final shoulder to form. If new high is formed, then it's no longer a head and shoulder, right? So what that means is a lot of people, they try to say, okay, here's the head pattern, right? Why don't I short here? Well, the reason why you don't want to do that is because you don't know that this is going to form this right shoulder, right? It could go back and gradually make higher highs. Okay, that happens all the time. You want to wait until this pattern is fully formed before you take action. You take action at the neckline. Okay, the other common mistake is to say, okay, I formed this right shoulder, let me get in here. But again, if it retraces and then it bounces back, makes higher highs, then you know, you're out of luck. But the reason you would be out of luck for that is not because just market vagaries, is because you didn't do your job and you didn't wait until it tested the neckline again. And again, we want to look for conviction. Okay, watch out for false breakouts. Those are the wicks I was telling you about, and we can often identify. This is important. Do you guys know? Have you guys gone over candlestick reversal patterns yet?
Yes, I think so.
Okay, because that's absolutely vital with this. Here's an example of a false breakout, right? So this is obviously a head and shoulders pattern. You see I have some, you know, I have this little wick here. Also notice the volume here is less than a lot of these, right? So that means I don't have the momentum that I want. Also, I have what's called a Pinbar reversal. It's called a Pinbar because it looks like that, right? And then guess what? It breaks out the other way, all right? So if I traded this, I'd be fucked. Okay, so what you want to do is either, if you do in the moment see this momentum, you keep a fairly narrow stop, because if something like this happens, you at least want to get out with minimal risk, okay? And you know, also you want to wait for that momentum if you see it. Okay, so again, waiting for conviction. The large bar in the direction of the breakout, that's what we want. And the stop loss would be the base of that bar. Again, going back to this example, setting a stop loss here, like right about where the head of that candle is, or the high, is a good idea, right? Because I'm minimizing my risk. For example, this is one where it did work out, and I did trade this. You have again, your head and shoulders pattern, your dick and balls pattern, and then we have a breakout here in the direction that we want, right? So we have this nice large bar of conviction, fairly decent volume, not necessarily so much than the other one. But if I took this trade, the risk management is clear, it's well defined. And that's what you want, because you're never going to be certain, right? So you just want to make a trade where your risk is well defined. So my risk here at this bar is going to be the base. That's what I'm choosing to risk if I enter the trade about the neckline. And you know, the profit target typically for these is like a 50% retracement of whatever came before here, right? So I could be making all this to risk just that much. So that's why I like head and shoulders patterns a lot, is because the risk is well defined and you could stand to make a tremendous profit if you're right. Okay, and that pretty much wraps up the head and shoulders slides, and yeah, I think that's about all. So you guys have any questions? I know I threw a lot of material at you today. Hopefully I'll be able to join again. You know, and fill in some of what I had to kind of skip over. But otherwise, any questions?
No.
All right. All right, cool. Well, I guess in that case, we'll go ahead and call it a night.
Yeah, thanks for taking over the class and giving us some different insight.
Hey, man, it's my pleasure. You know, I'm going to be standing in for Chen, you know, not only on Discord, but on, you know, in general for these courses. I may, in the beginning, have to jump in with some of my content. I haven't really reviewed his modules, but eventually I'll be in a position where I can present both of them. You know, anytime you guys have any questions on technicals, I'm fairly available on Discord. Send me a message. You know.
Perfect. Thanks a lot. Eh?
Cool, man. Anytime. Yeah, you too. Talk to you guys soon. Yep.
Anyhow,
yep.
Can you share the PowerPoint on the technical?
Absolutely, man. I'm going to pop it in Discord right now, okay?
Okay.
All right. Thanks a lot, guys.
Okay. Thank you, Daniel.
All right. Take care. Bye-bye.